Good afternoon. This is Sean Golden with Golden Golden. Hope everyone out there had a good or at least timely tax season. Today we're here to discuss U.S. tax planning for foreign nationals. So next year, around this time or in April, you'll be good to go. So when it comes to tax planning for foreign nationals, key distinction is U.S. person versus non-U.S. person. For example, are you planning as a non-U.S. person to reside outside of the United States and invest within the United States, or are you relocating to the United States or otherwise becoming a U.S. person and you want to get your taxes together before, because pre-planning is generally the best way to go. So when it comes to U.S. person, it typically refers to three categories: a U.S. citizen, a lawful permanent resident, aka green card holder, or a foreign national who meets the substantial presence test. Normally you're on a visa, maybe you don't have to be, but maybe you're here on H-1B, L-1, O-1, E-2, E-3 treaty visa, and you spend a significant amount of time in the United States sufficient to become considered a U.S. person. In that situation, you're a U.S. person. Otherwise, maybe you're living outside of the United States, you don't fall into any one of these categories, but you want to make investments in the U.S., whether it's you want to invest in bonds or funds or real estate. You want to plan because the tax implications can be different. Why don't we start with U.S. person? Let's say you're a foreign national, you decide you want to come to the United States. The U.S. is one of only a handful of countries, actually two, that follows what's called a worldwide income model. What that means is the U.S. taxes you on your worldwide income. You become a U.S. person, maybe you invest in some U.S. assets that generate some income, but you already have income outside the United States. Well, guess what? You're taxed on both of that income. And it can be distressing, especially for taxpayers who live in countries where they don't tax that category of income. For example, in several Asian countries, it's common that you don't get taxed on certain passive income, such as interest, capital gains, dividends. I mean, it's not a straight rule like that, but a lot of countries have that. Once you come to the U.S., those sources of income may be taxable, and worse yet is you don't have any foreign tax credits, right? When you have foreign tax credits, which I'll get to in a minute, you can apply them, but you won't have them because it's not taxable in the foreign country. If you had assets outside of the United States, well, now you may have a whole host of different reporting requirements. It's not just tax, it's reporting. The reason why reporting is so crucial is because the IRS really likes to penalize people. They want to assess penalties for your non-compliance. Some of the more common forms of the FBAR, foreign bank and financial account reporting, is used to report all types of bank accounts, pension plans, certain life insurance policies, pooled funds like mutual funds and ETFs that you have outside of the United States. FATCA, Foreign Account Tax Compliance Act, it's similar to FBAR, a little bit different. The threshold's a little higher. There's Form 5471, which is used to report foreign corporations, 3520, used to report gifts from foreign persons. This is a big issue. You became a U.S. person and your sweet grandma just gifted you $300,000 in your mind. It's just a gift from your grandma. She's never stepped foot in the United States, and the money's from outside of the United States, so who cares? From the U.S. perspective, you as now a U.S. person received a gift from a foreign person. If you don't report it, you can get penalized. Oftentimes, by the time you figure that out or you learn about it, the penalties jumped up to the max, which is 25%. And then 3520-A refers to when a U.S. person owns a foreign trust. 3520 would also be reported in that situation as well, but the 3520-A is more complicated, balance sheets and profit and loss and things of that nature. Also significant penalties for not reporting that. Now, if you've paid tax overseas, like I said earlier, you may qualify for FTC, which is the foreign tax credit. It's not always dollar for dollar, but it typically will reduce your tax liability. If you're working overseas, let's say you become a U.S. person, a green card holder, then you go and you work outside of the United States, you're not typically a foreign national anymore unless you've given up your status. But you can qualify for the foreign earned income exclusion and the foreign housing exclusion, which typically allows you to exclude upwards. I think it's about $109,000 now for foreign earned income exclusion, another $12,000 to $25,000 in housing. So depending on how much you're earning that way, you may be able to significantly reduce your tax liability. Spouses can each file it. If you are a non-U.S. person and you're investing in the U.S., well, you also have to do some planning as well. Some of the more common issues, FDAP, fixed determinable annual periodic. So when you're a non-US person and you have passive income, they kind of just group it all into FDAP, and there's 30% withholding, 30% tax. Now, if you're in a treaty country, you may be able to apply to reduce or even eliminate that withholding depending on the specific treaty. There's about 60 of them. They're not all identical, but they're similar. So that's something to consider if you have a lot of FDAP. ECI is effectively connected income. You may have a U.S. trade or business. You're taxed at the progressive tax rates. Sometimes you can take FDAP and turn it into ECI, which is a benefit. Common example is real estate. So let's say you're a foreign national, you own U.S. properties, you're generating rental income. Well, it's FDAP off the bat, and so you're going to get 30% withholding, which is ridiculous. Your renter's going to send the money over to you. Not that they ever do, but they're supposed to. You can make an election to treat it as ECI, then you can take all those deductions you would otherwise take: commissions, marketing, advertising, cleaning, maintenance, HOAs, real property tax, etc., etc. So that's something to consider as well. FERPA is the Foreign Investment and Real Property Tax Act. So baseline perspective, non-US person, capital gains are not taxable. There's exceptions and exclusions and limitations, etc., etc. But for the most part, it's not taxable. That does not include real estate. So a foreign national owns U.S. real estate and they sell it, it's going to be taxed, and the U.S. is going to withhold 15%. So even, let's say you bought a home for $500,000, let's say you sold it for $600,000. They're going to withhold 15% of the sale price, which is absurd when that exceeds your gain. Things you can do, there's certain elections you can make. You can request a certificate to reduce or eliminate the withholding. It can be issues depending on what state you're in when you're doing the sale, because there's timing issues. You don't want to lose the buyer, right? But something to consider. And then Form 5472 is when foreign national own 25%, U.S. company or disregarded entity. Form 5472 is kind of sort of similar to 5471, only it's for foreign nationals operating in the United States. The penalties for these are severe. Failure to file the form starts at $25,000. It used to be $10,000, similar to the 5471, which is when a U.S. person owns a foreign corporation, but they more than doubled the penalty a few years back. If this is all new to you and you're out of compliance, don't worry. Take a deep breath. Avoid the obnoxious fear-mongering you will undoubtedly find in your research quest. There are many amnesty programs available to assist you. There is the voluntary disclosure program. That's for people who are willful. If you're non-willful, you have a lot of options available: streamlined domestic, streamlined foreign, reasonable cause, and delinquency procedures. We have a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.